Many investors view the Schwab US Dividend Equity ETF, or SCHD, as a reliable, hands-off investment option. While SCHD is indeed a strong dividend-focused ETF, approaching it without a well-defined strategy can lead to suboptimal returns or even hinder your financial progress. A common misconception is that SCHD's high dividend and solid performance history eliminate the need for active management. However, this assumption can result in costly errors, such as stunted portfolio growth, reduced passive income, and setbacks in achieving your financial objectives. In this video, we'll break down 9 most significant mistakes investors often make with SCHD and how to avoid them. Additionally, I will show you how a modest daily investment, less than a cost of a typical coffee, can grow into a portfolio nearing $1 million, generating over $70,000 in annual dividends and equating to more than $5,000 in monthly income. Let's get started. Ignoring dividend growth. First on our list of the common mistakes among investors is focusing only on high dividend yields, while overlooking the importance of dividend growth. A strong yield might seem appealing, but if the dividends aren't increasing over time, your purchasing power could shrink. This is where SCHD stands out. Over the past year, its dividend growth rate has been an impressive 12.23%, far surpassing the 7.74% median growth rate of other ETFs. Looking at a longer period, SCHD has maintained a 5-year compound annual dividend growth rate, or CAGR, of 11.59%, while the average ETF lags behind at just 4.77%. To put this into perspective, if you earned $100 in dividends today and they grew at 11.59% annually, in just 5 years, your dividends would rise to about $170. But if you only focus on a high current yield without considering growth, you could end up stuck with an ETF that pays well now but fails to keep up with inflation. Time the market instead of staying consistent. Attempting to time the market, trying to buy low and sell high based on short-term predictions, instead of sticking to proven methods, is another common mistake among investors. Even professional investors often find it challenging to consistently forecast market movements. This approach can lead to missed opportunities and diminished returns. A more reliable strategy is to invest consistently over time, regardless of market conditions. This method, known as dollar cost averaging, involves regularly investing a fixed amount, such as monthly or quarterly. By doing so, you purchase more shares when prices are low and fewer when prices are high, effectively averaging out your purchase price over time. This strategy reduces the risk of making significant investments at inopportune times. For example, during market downturns, investors who maintain a consistent investment approach can acquire assets at lower prices, potentially enhancing long-term returns. Conversely, attempting to time the market by withdrawing the investments during downturns can result in locking in losses and missing subsequent recoveries. Historical trends indicate that markets tend to recover over time, rewarding patient investors who stay the course. Focusing only on dividend yield. Some investors found it easy to get excited about SCHD's attractive dividend yield. After all, with a yield of 3.55%, SCHD outperforms the median ETF yield of 2.78% by a significant 27.75%. That sounds like free money, right? But here's the mistake many investors make. They focus only on yield without considering the bigger picture. A high dividend yield can be tempting, but it doesn't automatically mean an investment is secure for the long haul. Many investors fall into the trap of chasing high yields while overlooking a crucial factor: dividend sustainability. Just because a company or fund pays a strong dividend today doesn't guarantee it'll continue to do so in the future. Economic downturns, business challenges, or shifts in market conditions can put pressure on companies within SCHD. If a company's financials weaken, it may be forced to cut or reduce its dividends. This not only impacts your expected income, but also can drag down the value of your investment. That's why it's essential to look beyond yield alone and focus on the stability and growth potential of your dividend-paying investments. Thinking SCHD is risk-free. At mistake number 3, we talked about focusing too much on dividend yield. But here's an even bigger issue. Assuming SCHD is a completely risk-free investment. While focusing on dividend yield without considering sustainability is a common error, an even bigger misstep is developing a false sense of security with SCHD. Just because an ETF pays dividends doesn't mean it's immune to market downturns. Economic challenges, industry disruptions, or corporate struggles can lead to profit declines, which might force companies to reduce or even eliminate dividend payments. SCHD has a strong track record, having increased its dividends for 13 consecutive years, far surpassing the average ETF, which typically manages just 1 year of growth. However, history doesn't guarantee future performance. Market conditions can shift, and assuming SCHD is completely safe could leave you unprepared for potential risks. A smart investor always acknowledges market volatility and diversifies their strategy to protect long-term wealth. Ignoring SCHD's underlying holdings. Even if you're aware that SCHD carries risks, many investors still make a critical mistake by trying to ignore SCHD's underlying holdings. Many assume that because SCHD is an ETF, it automatically provides broad diversification. However, that's not always the case. SCHD is a collection of different stocks, but its sector allocations aren't evenly spread. If you don't pay attention to what's inside the fund, you could unknowingly expose yourself to concentrated risks. For example, financial stocks make up 18.85% of SCHD's portfolio, while industrials account for 11.35%. This means that if the financial sector experiences a downturn, such as a banking crisis, SCHD could take a harder hit than a more balanced ETF. Similarly, if economic conditions weaken and companies cut back on manufacturing and infrastructure spending, SCHD's industrial holdings could also suffer, weighing down the fund's overall performance. Assuming you're diversified just because SCHD holds over 100 stocks can be misleading. If many of those stocks are concentrated in a few sectors, your portfolio may not be as well balanced as you think. And that leads us to another critical investing mistake: not reinvesting dividends. Many investors focus on buying dividend-paying stocks but overlook a crucial step: reinvesting those dividends. Instead of letting dividends accumulate as cash or withdrawing them, putting them back to work can significantly boost your long-term returns. Dividends are more than just passive income. They can become a compounding machine. By reinvesting them, you purchase additional shares, which then generate their own dividends. Over time, this creates a compounding snowball effect, multiplying your portfolio's value far beyond what you'd achieve by just collecting payouts. Let's look at the numbers. Suppose you invest $10,000 in SCHD, but don't reinvest dividends. After 30 years, assuming historical performance, your portfolio would grow to $97,056. Not bad. But here's what happens when you reinvest those dividends instead of cashing them out. Your $10,000 could soar to $464,215 in the same 30-year period. That's almost 5 times more wealth, simply by letting dividends buy more shares rather than sitting idle. Why is that? Every invested dividend buys more SCHD shares, increasing your future payouts. Without reinvesting, your returns are limited to dividends from your initial investment. But with continuous reinvestment, those dividends keep generating more dividends, amplifying your returns over time. Ignoring this strategy means leaving hundreds of thousands of dollars on the table. Whether you're investing for retirement or financial freedom, dividend reinvestment is a proven method to accelerate wealth building. Later, I'll show you how investing the cost of a daily coffee can help you retire with nearly $1 million portfolio and a monthly dividend income exceeding $5,000. Not diversifying beyond SCHD. Relying solely on the SCHD for your investment portfolio might seem like a straightforward strategy, but it can inadvertently limit your diversification and investment potential. Many investors assume that because SCHD holds over 100 companies, they're fully diversified. However, SCHD focuses exclusively on U.S. dividend-paying stocks, which means entire segments of the market, like international equities and high-growth tech companies, are left out. For instance, only 10.22% of SCHD's portfolio is allocated to technology, even though tech is one of the fastest-growing sectors globally. Major players like Amazon and Google, which drive significant market growth, don't pay dividends, so they aren't included in SCHD. By investing only in SCHD, you could miss out on the substantial growth potential these companies offer. To build a more balanced portfolio, consider complementing SCHD with investments in other sectors, such as growth stocks or international markets. But even with proper diversifications, there's still another critical factor that investors often overlook: ignoring the fund's rebalancing schedule. Another common mistake among investors is neglecting to monitor the rebalancing schedule of their chosen funds, such as the Schwab U.S. Dividend Equity ETF SCHD. Rebalancing refers to the periodic adjustment of a fund's holding to maintain alignment with its investment's objectives. For SCHD, this process occurs quarterly, ensuring the fund continues to meet its criteria for dividend-paying U.S. companies. Understanding SCHD's rebalancing process. SCHD tracks the Dow Jones U.S. Dividend 100 Index, comprising 100 high-quality U.S. companies with consistent dividend histories. To remain in the fund, companies must meet specific criteria, including consistent dividend payments. Companies must have a history of paying dividends for at least 10 consecutive years. Financial metrics evaluation. Assessment based on return on equity, dividend yield, dividend growth rates, and free cash flow to debt ratio. Dividend sustainability. Companies should demonstrate the potential to continue and grow dividends in the future. Every quarter, SCHD adjusts the weightings of its holdings to prevent any single company from dominating the fund, thereby maintaining diversification and mitigating risk. Additionally, an annual comprehensive review is conducted to remove companies that no longer meet the stringent criteria and to introduce new qualifying companies. Implications for investors. Ignoring SCHD's rebalancing schedule can lead to unexpected changes in your investment portfolio that includes dividend income fluctuations. If a high dividend-paying company is removed during rebalancing, you might experience a decrease in dividend income. Altered sector exposure. The addition or removal of companies can shift the fund's sector allocation, potentially affecting the overall risk and return profile. Staying informed. To avoid surprises, it's crucial to stay informed about SCHD's rebalancing activities, which are: keep track of SCHD's quarterly rebalancing updates to understand changes in holdings and sector exposures. Regularly examine the fund's holdings to ensure they align with your investment objectives and risk tolerance. Be aware of any changes in dividend income resulting from rebalancing and adjust your financial planning accordingly. Keeping up with SCHD's rebalancing is important, but it's just as crucial not to get caught up in the hype of individual stocks. During a bull market, it's tempting to shift your money out of SCHD when you see certain stocks soaring. However, chasing short-term gains can derail your long-term investment strategy. Maintaining discipline and sticking to your plan is key to building lasting wealth. And this leads us to the last common mistake on our list today: failing to consider SCHD's long performance. Focusing too much on SCHD's short-term performance while ignoring its long-term potential. It's easy to get caught up in monthly or yearly returns and assume SCHD isn't performing well compared to other investments. But SCHD is built for long-term growth and stability. If you only look at short-term returns, you might make poor investment decisions without seeing the full picture. Let's break it down with numbers. In the last month, SCHD had a total return of 1.87%, slightly below the median for all ETFs at 2.26%. Over 6 months, SCHD's total return was 2.96%, which is 21.99% lower than the median ETF. If you stop here, it might seem like SCHD is underperforming. But here's where many investors go wrong. They don't zoom out to see the bigger picture. Over the past 3 years, SCHD has delivered a total return of 18.27%, which is 22.58% higher than the median ETF. Looking at a 5-year period, SCHD's total return is an impressive 74.93%, nearly double the median return of 37.73%. This shows that while SCHD might not always outperform in the short term, it provides strong, consistent growth over time. Now, let's talk about how SCHD can help you build a retirement portfolio with steady dividend income. Suppose you want to retire with a portfolio that pays $2,000 per month in dividends. If you start investing $10,000 at age 30 and reinvest all dividends, your portfolio could grow to $464,500 by age 60, generating between $2,000 and $3,000 per month in dividend income. This growth comes from the combination of capital appreciation and reinvested dividends. If you're 10 years away from retirement and need to build enough wealth for $2,000 per month in dividend income, you'll need to invest more aggressively. In this case, starting with $200,000 instead of $10,000 could grow your portfolio to $619,568 in just 10 years with dividends reinvested. The larger starting amount helps you reach your goal faster, but the risk is also higher since you have less time to recover from potential market downturns. The key takeaway? SCHD isn't designed for quick wins. It's built for long-term success. Staying focused on the bigger picture and reinvesting dividends can help turn a modest investment into a powerful source of retirement income. Conclusion. Now, this is a little secret of SCHD. Building a substantial passive income doesn't necessarily require a massive upfront investment. You can consistently invest a modest amount, such as $7 per day, into SCHD that will enable you to have the power of dividend growth and compounding to create a reliable income stream over time. SCHD is designed to track the performance of high dividend yielding U.S. companies, offering investors both income and growth potential. As of recent data, SCHD has a dividend yield of approximately 3.55% and has demonstrated a compound annual growth rate, or CAGR, of about 10.45% over the past 5 years. Let's be more simple. Imagine starting with nothing and simply investing $7 a day into SCHD. Even with this small, consistent habit, your money doesn't just sit, it grows. SCHD offers a solid 3.55% dividend yield, along with an impressive dividend growth rate of 11.04%. By reinvesting those dividends, you're not only earning returns on your contributions, but also on the dividends themselves. In just 5 years, your daily $7 investment could grow to $16,156. Stick with it for 10 years, and your portfolio could reach $45,211. Fast forward to 20 years, and your investment could be worth an impressive $208,807. But the real magic happens over time. After 40 years of consistent investing and reinvesting dividends, your portfolio could skyrocket to $938,250. Out of that, only $76,650 would have come from your own contributions, while reinvested dividends would have added around $442,900, bringing your portfolio value to roughly $861,000. Which mistake have you learned from and plan to avoid? Let us know in the comment section. If you found this video helpful, don't forget to like, subscribe, and share for more interesting videos like this on wealth building.